Every time the market gets shaky, people start asking the wrong question. They ask, what should I avoid? They ask, how bad is this going to get? They ask, should I wait until things feel safer? And almost nobody asks the only question that has ever really mattered if your goal is to build wealth in public markets. What is getting marked down while the long-term story is still getting stronger? That is the question, because downturns, pullbacks, corrections, and ugly months do not just destroy confidence. They also reveal opportunity. They shake out weak hands. They force people to sell names they do not actually want to part with. They compress valuations in businesses whose future may still be improving underneath the fear. And if you can keep your head while the market is emotional, that is when you begin to separate yourself from the crowd. Now, I want to be very clear before I go any further. I am not interested in hot tips. I am not interested in trying to impress you with a list of 5 tickers and some dramatic language. What matters to me is whether the reasoning survives when the excitement is stripped away. A stock is not attractive because somebody says it is. A stock is attractive because the relationship between price, growth, valuation, and probability has tilted far enough in your favor that patience becomes rational. That is the standard. And the reason lists like this can be useful is not because you should copy them blindly, but because they force you to think in categories. What kind of setup am I looking for? Do I want a dominant giant being repriced lower while its earnings keep growing? Do I want a company right at the edge of an operational pivot? Do I want a smaller, more speculative name that could re-rate if the business survives the ugly transition and enters the better phase? Those are very different questions. So, what I want to do is walk through this list the way I would want a serious investor to think about it. Not as a hype reel, as a framework. Because if you understand the framework, you can survive 100 lists. If you only memorize the names, you will panic the first time the price goes the wrong way. Let us begin with the biggest name on the list, because that is where the market always seems to return whenever people start talking seriously about artificial intelligence. NVIDIA. This stock has been one of the central engines of the entire AI trade. That is no secret. And because that story has become so well known, people now make one of 2 lazy mistakes. The first group says, I missed it, the easy money is gone. The stock has gone nowhere for months. The story must be over. I think both reactions are shallow. A great company does not stop being great because the stock takes time to digest prior gains, and the market has a way of making strong businesses look boring for stretches precisely when they are becoming more interesting under the surface. That is what I think people are missing with NVIDIA right now. The stock has not behaved the way the excitement around the business would suggest. It has gone sideways, it has looked tired, it has failed to give people the explosive continuation they expected. And because ordinary investors are addicted to momentum that validates them immediately, they start doubting the name the moment it stops rewarding them on schedule. That is not how I think. When I see a company whose earnings outlook keeps expanding while the stock price consolidates, I do not become bored. I become curious, because there are only so many ways for that tension to resolve. Either the business slows and catches down to the stock, or the stock eventually wakes up and catches up to the business. Now, the case being made here is that NVIDIA's valuation has quietly compressed to levels that are unusually attractive relative to its own history and relative to large-cap technology more broadly when the market is feeling healthy. That matters because price-to-earnings multiples are not just abstract ratios. They are the market's way of telling you how much future greatness is already priced in. And if a company is still showing extraordinary earnings power, still benefiting from the core force behind AI infrastructure, still seeing the demand engine expand, and yet the multiple has contracted sharply, then the market may be handing you a better entry into the same long-term story. That is the setup. Now, there is another layer here that I find very important. The guidance itself, when a company of this size keeps posting growth that would be unusual even for a much smaller business, it deserves attention. Not worship, but attention. That is one of the things that separates NVIDIA from a lot of the imitators and satellites around the AI. Boom, it is not just a symbolic winner. it is still producing the sort of numbers that force even skeptical investors to stop and ask whether the sideways stock action is telling the full story. And then comes the China angle. This is where things can get even more interesting, because if prior expectations were built before a meaningful reacceleration of orders from China, then the current market consensus may still be understating what the next set of numbers could look like. I do not say that lightly. Markets can underprice a story when they become too exhausted by the stock's past success to notice that the next leg may still be forming. That happens. The market is not always early. Sometimes it simply stalls and waits for the next proof. Now, why would a stock like this stay flat for so long if the business remains so strong? There are several reasons, and most of them are not mysterious. Investors who are early are taking profits. Capital is rotating into other names. The market is broadening. Money that once hid in the biggest AI winner is being redistributed into places perceived as lagging. That is normal. But what matters is whether the support level holds while all that rotation happens. If it does, then the stock is not dying. It is consolidating, and consolidation at a high level after a massive run can be a bullish condition rather than a bearish one. That is what many people fail to understand. Not every flat chart is weakness. Sometimes it is digestion, sometimes it is coiling, sometimes it is simply the market allowing fundamentals to catch up, so the next advance can happen on stronger footing. That is why I still find NVIDIA compelling here. Not because the name is exciting, because the relationship between the current valuation and the earnings engine underneath it may be far more attractive than the crowd realizes. Now let us move to the second name, because this is where the story gets more speculative, more frustrating, and potentially more rewarding if it plays out properly. Advanced Micro Devices. AMD is one of those names that has lived for years inside the shadow of what it could become. The stock runs ahead. Then the actual operating results remind everyone the future has not arrived yet. Then new product optimism returns. Then the cycle repeats. That is exhausting for weak hands. But it is also exactly how major transitions often look, while the market is trying to decide whether a company is merely promising or actually pivoting into a different category of profitability. And the case being made here is that the pivot is real. The product cycle matters. The Mi Wuxi launch matters. The hyperscaler story matters. And the broader point is simple. If AMD is finally crossing from interesting alternative to serious large-scale participant in the AI compute stack, then the current year earnings multiple can be a misleading way to judge the opportunity. Because when a company is standing right before a major acceleration phase, the current year often tells you less than the forward trajectory. That is uncomfortable for conservative investors, because it asks them to believe in a future that has not fully shown up in the numbers yet. But that is also where the outsized returns often live. Not after the new regime is obvious to everyone at the pivot. Now, I want to emphasize something very important about AMD. This is not NVIDIA. That is not an insult. It is simply true. NVIDIA is the established monster in this cycle. AMD is the company trying to capture more of the demand that is still far too large for one firm to satisfy cleanly. And that distinction matters because the market treats those two types of businesses differently. NVIDIA gets the premium of proven dominance. AMD gets the volatility of a company whose future is still partly an argument. That means the stock can overshoot and disappoint more often, because each new product cycle invites investors to project too much too soon. We have seen that before. AMD rallies on the dream. Then the market remembers the dream still needs time. Then it pulls back. Then new evidence emerges. Then it rallies again. That can be maddening if you do not understand what kind of stock you are holding. But it can also be very rewarding if you do. If the market is once again at the point where it is beginning to believe the next real acceleration is finally near, then this could be another one of those stretches where the stock shifts from being treated like a maybe to being priced more like a real second force in the AI infrastructure build-out. And the demand discussion matters here more than almost anything else. If overall GPU demand is still vastly above available supply, If data center demand remains robust, if edge AI demand is broadening, if refurbishment cycles create ongoing repeat demand on top of new deployment demand, then there is room in this market for more than one winner. That is what ordinary investors often miss. They think if NVIDIA is great, everyone else must fail. That is not how real booms work. When a category expands fast enough, multiple companies can grow enormously at the same time. The demand is the story, and if demand remains structurally strong, then AMD does not need to kill NVIDIA to reward its shareholders. It simply needs to capture enough of the market to justify the future that is beginning to form around it. That is a very different threshold, and one I think many people still underestimate. Now, let us move to the third stock, because this is where you begin stepping out of giant, well-known AI names and into something more fragile, more volatile, and potentially more explosive. If the build-out precedes Nebius, this is the application layer of all the GPU mania. The data center build story, the revenue backlog story, the debt-funded expansion story, and I want you to hear that last part carefully, because this is where investors often become sloppy. Debt is not automatically bad. Bad debt is bad. Debt taken on to finance capacity for demand that may never materialize is dangerous. Debt taken on because demand is already there and the bottleneck is building enough infrastructure to recognize that revenue is a different thing entirely. That is the argument here. The backlog is real. The demand is real. The company is building to meet it. And the debt, while it looks uncomfortable to the casual observer, is tied to scaling into an opportunity rather than surviving a collapse. That is a meaningful distinction. It does not remove the risk. It changes the type of risk. You are no longer simply asking whether the company can survive. You are asking whether it can execute. That is a much more interesting question. Now, Nebius has already had a big run that makes people nervous. They say, why would I buy something after a sharp move? And that is a reasonable instinct in many cases. But it can also become a lazy one. A stock near highs is not automatically dangerous any more than a stock near lows is automatically cheap. What matters is whether the higher price still leaves enough room relative to the business trajectory, and whether the trend is confirming a real operating improvement or merely a temporary emotional spike. In this case, the run-up followed an earnings release that affirmed the outlook, validated the backlog, and made clear that the debt was part of building into demand rather than papering over weakness. That is exactly the kind of update that can justify a re-rating. Now, does that mean you should chase it blindly? Of course not. Smaller names like this are volatile because they have not fully established themselves. They are still proving the scale. They are still translating the story into durable quarterly evidence. That means the stock can and will have violent swings, and you must know that before you buy, not after. If you buy a name like this and then discover you hate volatility, you did not make a bad trade. You made a bad match between asset type and temperament. Those are different mistakes, and I always want investors to separate them. So for Nebius, the real question is not whether it is volatile. It is whether the uptrend remains intact and whether pullbacks are presenting opportunities inside a still bullish structural move. That is where support matters. That is where waiting for weakness and buying into stabilization can make far more sense than either panicking at the first pullback or buying as if every green candle guarantees another one tomorrow. Now let us move to the fourth name, because this is where the list becomes even more specialized. Amprius Technologies. This is one of those names that can look strange or obscure until you understand what the product actually gives customers. Then the logic becomes clearer. The battery technology works. That is the essential point. And when a technology works in a context where government contracts, defense demand, robotics, drones, and future commercial applications all begin lining up behind it, the market starts seeing not just one source of revenue, but a chain of future demand layers. That is what makes this sort of company interesting. Not just current sales, the order in which future markets could open. Now, I want to be careful here. Small cap growth stories are where people get themselves into real trouble because they fall in love with the dream and never check whether the company is actually moving through the right milestones. That is why I care so much about confirmation, ramping production capacity, improving access to government contracts, repeat orders, institutional support, analyst support, an uptrend with higher levels of support after each pullback. These things matter because they tell you whether the market is gradually treating the company as more real and less theoretical. And that seems to be the case here. The stock has already moved significantly. That is true. But the way I think about it is not, has it gone up already? The better question is, has the business moved into a new operating zone that justifies a new trading range? If the answer is yes, then yesterday's price may not matter much. What matters is the distance between the company's new reality and what the market will eventually price in if that reality keeps getting confirmed. That is the point with something like AMPX. Not to stare at where it traded last year and feel you missed it. To ask whether the company is entering a phase where the market is still early relative to what the technology and the demand pathways could create. And again, I must stress the distinction between volatility and brokenness. A small company can remain deeply volatile even as the underlying case improves. In fact, that is often how these transitions happen. The stock runs, pulls back, finds a higher floor, then runs again as new evidence accumulates. That step pattern is often more useful than a single explosive move because it shows that each retreat is being met at a stronger level. That is how institutions often enter quietly, repeatedly at improving support zones rather than in one theatrical rush, and I think that is what makes the setup appealing here. Now, I want to move to the fifth stock because this is the one that changes the tone of the list. Big Bear. This is not a comfortable blue chip buy. This is not a name you own because it already proved itself in every category that matters. This is the type of stock you own, if you own it at all, because you believe the bad phase is ending and the better phase is beginning. That is a very different kind of setup, and it requires a very different level of discipline for a while. There were too many reasons not to like it. Dilution, short pressure, weakness, transition risk. A story that was easier to tell than to trust. But the argument now is that some of the ugliest overhangs have been cleared. The balance sheet has improved. The transition has progressed. Acquisitions have expanded capability. Government contract pathways have broadened. And if that is true, then you can get the sort of setup that smaller speculative names occasionally produce. The shorts start to lose part of their thesis. Institutions begin seeing an improving case. The market realizes the company is no longer in the same bad period it was priced for, and then the stock can move much faster than a normal business would, precisely because it had been so heavily doubted beforehand. This is what makes these situations so dangerous and so attractive at the same time. If the good period does not actually arrive, you are left owning a fragile story. If it does arrive, you are no longer holding just a recovering business. You are holding a re-rating candidate. That is where the asymmetry lives. Now, I want to be very clear. This is still speculative. I would never let a name like this pretend to be a foundation stone in a serious portfolio. That would be foolish. But inside the right risk bucket, where an investor understands exactly what kind of business he is dealing with and what kind of volatility comes with it. I understand the appeal, because when a company exits a bad regime and enters the first innings of a better one, the stock can move in a way that looks ridiculous, only to those who were not paying attention to the pivot. And the government and defense angle matters here. It matters with Palantir too. It matters with the AI-enabled services theme more broadly. These are not just software buzzwords. These are capability stories tied to border systems, analysis systems, contract channels, and increasingly to the way states want to use data, automation, and intelligence in the real world. If that market expands over several years, then companies plugged into it do not need perfection. They need enough traction to prove they belong. And if Big Bear is now entering that more credible category, the stock may still be early relative to the full runway. Now, I want to zoom out, because if you only hear 5 tickers, you will miss the real lesson. There is a common thread running through all 5 names. It is not simply AI. It is the relationship between volatility and valuation during periods when the broad market feels uncertain. That is what creates these windows. The market shakes, fear rises, weak holders sell, Stories that remain fundamentally intact get cheaper or stay suppressed long enough for stronger hands to build positions. That is the opportunity. And the opportunity does not look safe in the moment. That is why it is an opportunity. If it looked comfortable, it would already be crowded. Now let me tell you what I think is the most valuable part of the source document. Not the names, the closing philosophy, always be buying. That is the real engine underneath all of this, because most investors ruin themselves by waiting for perfect timing. They want the exact bottom, they want total clarity. They want to buy only after all fear is gone and the chart already feels friendly again. That is fantasy. The market does not hand out perfect setups with a polite invitation attached. By the time the average person feels good, much of the easy money is often already gone. That is why system beats emotion. If you believe in long-term ownership, then repeated, automatic buying is one of the simplest and most effective habits you can ever build. Buy when it is sunny, buy when it is raining, buy when there is a Republican, buy when there is a Democrat, buy when tariffs are on, buy when tariffs are paused, buy when the market is euphoric, buy when the market looks ugly. Not because every price is equally attractive, because your behavior matters more than your attempts at theatrical precision. Now, that does not mean you are forbidden from becoming more aggressive when the market sells off. On the contrary, if your foundation is strong and you have cash available, pullbacks can be gifts, but the gift only belongs to the person already in the habit of acting. The person waiting for perfect certainty usually gets neither certainty nor the best price. That is the trap. I have watched it play out again and again. In Ardian Ardium, people begged for the market to stop falling before they bought. Then it turned in Ardian RR. Same thing. In each tariff scare, same thing. People always think the next leg down is inevitable. Right before the market remembers, it can recover faster than their emotions can process. That is why the automatic system matters so much. It bypasses your panic. It bypasses your ego. It bypasses the need to feel clever. And that is one of the great hidden truths of investing. People would often rather feel smart than become rich. They want to brag about buying the exact low. I would rather quietly own a lot more productive assets 20 years from now. That is the difference. So if I put this whole list into one sentence, it would be this. These are not simply 5 stocks. They are 5 examples of how the market can misprice different phases of growth. When fear, uncertainty, and narrative pressure distort the relationship between price and future business value. NVIDIA is the giant whose valuation may have become too cheap relative to its earnings engine. AMD is the challenger whose pivot could finally be entering the revenue phase that justifies a higher multiple. Nebius is the infrastructure builder whose debt is tied to backlog and expansion rather than decay. Ampex is the technology story whose product and contract pathway may be pulling it into a higher operating zone. Big Bear is the speculative transition case where a company may be emerging from the bad chapter into the first pages of a better one. Different levels of risk, different levels of maturity, different reasons for being on the list. But the same broad idea, the market is nervous, and nervous markets create windows, not forever, for those prepared to think clearly while others want comfort. Now, you do not need to buy any of these names just because they appeared on a list. That would miss the whole point. What you need is to start thinking the way the list is trying to teach you to think. Where is valuation disconnecting from operational reality? Where is a pivot approaching that the market has not fully trusted yet? Where is demand building faster than the stock is pricing? Where is fear creating entry rather than signal? And do I have the system, the temperament, and the time horizon to hold through the volatility that comes with these kinds of bets? Those are serious questions. If you can answer them honestly, you become a much better investor. If you cannot, then a ticker list is just entertainment. And entertainment is expensive when it enters a brokerage account. So we may be heading into April with the market in a shaky mood. Good. Shaky moods are often where future gains begin. Not because every falling stock is a bargain, because fear sometimes opens windows that logic later closes. Your job is not to panic. Your job is to know the difference.